Welcome back to Burning the Ships Podcast Solo Show, the show where we go all in on business, health, family, and life without looking back. These solo episodes are designed to give you tactical strategies you can apply right away, followed by a mindset principle to help you anchor those strategies and execute with confidence. From time to time, I'll also bring in experts to dive deeper into specific areas so you're getting actionable tools and perspectives from all angles. This show is also brought to you by 608B Capital. At 608B, we provide short-term real estate loans for investors who need speed, certainty, and flexibility to scale their business. Whether it's a fix and flip or a buy and hold, our team understands the borrower side because we've been there and continue to be there ourselves. To learn more, visit 608bcapital.com. Now let's dive in. Welcome to Burning the Ship solo episode. I'm your host, Jason Seward, and today I'm going to continue kind of the series I've been doing on single family fix and flip and strategies and everything that kind of goes into that. I've talked about, in one episode, I talked about finding deals. I went over a whole bunch of strategies there. Another episode, I talked about once you find them, how to underwrite them, so how to run the numbers and kind of map out whether or not this is a good deal or not, if you want to offer on it, stuff like that. And then last week I talked about goals. Probably should have led everything with that, because as you go into this, you kind of need to know what your goals are and what you're targeting, because without that, you really can't build a roadmap, and it's hard to build a strategy without knowing what your end game is, what your goal, what you're trying to achieve. So I've talked about that last week. So now, once you've done all that, you set your goals, you search for your deals, you underwrite your deals, and you decide, okay, this is one I want to buy, or this is, one I want to take down, and I think it all works. Well, now you got to pay for it, right? So today we're going to talk about funding those deals, and I'm going to go through all the different options, miss a few because there's a bunch of them, but I'll go through the main ones. And as I go through these, I want to note that as I was kind of thinking through this episode and plotting it out, I have experience with every single one of these funding options, right? I've done all of them. So I can speak from an experience standpoint. I've done some way more than others, and now I'm a lender myself. So I am one of these options for people that are buying real estate. So I am, from an experience standpoint, again, I've done a lot of this. I have experience with it. I'm very knowledgeable with it. And I'll try to articulate that in a way that, if you're out there, you're trying to get it going, you're trying to figure out how to fund, you want to flip houses, you want to do the BRRRR strategy, stuff like that. I'm going to kind of give you some ideas to run with. And each one of these, I'm not going to go in depth with all these strategies. I want to present them to you and then encourage you to go do further research on each strategy, talk to your banks, talk to your investors, stuff like that. So before we get into all that, we're going to kick it over to my man JJ for JJ's Joke of the Week. Take it away, JJ.
Why did the student eat his homework? Because the teacher said it was a piece of cake.
All right, buddy. Another good one. My little comedian in the making. He's so excited to get back on here and record a bunch more jokes. I think he sat down and did like 20 or 30 of them. So once we get kind of close to being at the end of those, he'll pop back in here and knock out a bunch more. So he enjoys that. And I think I've joked before. Every time an episode comes out, I rarely go back and listen to episodes, but he'll ask me from time to time, "Hey, Dad, when can you put on a Burning the Ships episode?" And all he wants to hear is himself tell the joke. He could not care less about anything else. So it's kind of cute. So now, funding short-term or funding real estate deals, and I'm going to go through your options to do that, right? So we'll kick it off with cash. And this is how I got going with the bulk of my early real estate deals. I was only doing like one at a time, and I had enough savings to take these down with my cash in the bank, right? So I could buy them and fix them up. Didn't have to deal with the bank, didn't have to deal with the lender, didn't have to go through any red tape or anything like that, waiting for approvals or anything. I just paid cash for the deals I bought, and then would fix them up and either sell them or hold them as rentals. And if I held them as rentals, I would go through a refinance and pay myself that cash back, right? So that's the BRRRR strategy. I've talked about that a lot. If you're not familiar with it, look up BRRRR, BRRRR, and you can learn more about that. But that's the strategy we built our entire portfolio on, is the BRRRR strategy. It's just recycling money. We use a lot of cash to do that. So cash is the fastest and simplest way to do this, right? It's easy, but not everybody has cash in the bank enough to take down a deal. Or if you do, you're limited to only doing maybe one deal at a time or two deals at a time, like we were early on. And with that, that's the trade-off. If you're going to use your cash, it's fast, it's simple. You don't have to go through any approval process, but you're tying up your liquidity. So if you do one deal and your only strategy is to use cash to do these deals, and you've got enough to do that one deal, and now another great deal comes across your plate, and you hadn't explored other strategies other than cash, you got to pass on that deal, right? Or you could, if you're familiar with wholesaling or something like that, you could take it down that way. But for the most part, cash is very limited to how far or how big you can scale. The other trade-off with cash is, and this is something a lot of folks, I think they don't put enough thought into when they're using cash, but there is a cost to using cash. Again, that cost is you're tying up your own money, but that same cash that you buy a property with and that you're using for rehab, that cash could be invested elsewhere. You could put that cash into a mutual fund, a CD, a money market account, a T-bill, any other kinds of investments you could put that money in and get a return. But rather than doing that, you put it into this real estate deal. Yes, it's going to come with a return, but that opportunity cost of where that cash could be making money elsewhere, you got to factor in that as a cost of capital. And again, you're not having to pay interest on that money, but you are losing potential interest by having it, you could have it invested elsewhere. So it's very important, I think, and when you get into the economics of it all, if you're using cash, you have to factor in what you're losing by using that cash. So cash is your number one option, is your first option, and it's the one we started with. Another option similar to cash, but not similar at all in a lot of regards, is using retirement accounts, right? This gets pretty complex. I'm not going to go into the weeds here, but you can, if you have a self-directed IRA or a solo 401k, something that you have control over, you work through a custodial company, a custodian, shout out to Specialized Trust Company, that's the one we use, and you can invest in real estate through that retirement account. Now, real quick, this is how it would look. Now, I'm not going to get into the weeds, but just to give you a rough example. Let's say you're going to buy and fix up a house for $150,000. You can work through that custodian company where they will buy that real estate with your retirement funds, and then they will pay for the rehab through, and it's got to go straight to the contractor out of that retirement account. But when you sell that, all the gains and the money used have to pay back to that retirement account. You cannot take any of those funds personally without incurring a penalty and whatnot. So it is a strategy to use retirement funds to really beef up your returns in your retirement accounts. And if you have money sitting out there and you're just not happy with the stock market or other investments you have within that retirement account, this is a great way to have capital to fund your real estate deals. Okay, so that's another one. We got cash, and then we got cash through your retirement funds. So the next thing, and we Bill and I have both done that, more on the lending side, or like we've partnered with folks through our retirement fund. We haven't bought anything through our retirement fund, but we definitely have done a lot of lending through it. But it was a similar principle. We lend the money out, and the returns have to come back to that retirement fund, and gains. The next one, and this is probably the one that helped Bill and I scale the most, and those are lines of credit. So we both started as eerily similar because we were doing this independent of each other before we ever partnered on it. But around the same time, we both got HELOCs, home equity lines of credit. This is basically, we both had low leverage mortgages, first mortgages on our homes, which means the amount we owed on those mortgages was way less than the actual value of the property. So that gap, that spread, creates equity. So, and I don't mind sharing my numbers, but like at the time I got my first HELOC, I owed, I think, 275,000 on my house and land, and it was valued probably 700,000. So I had a lot of equity in there, over 400,000, and I was able to go to a bank, a credit union, and I shopped it around, but I found one that would give me the best terms on a HELOC. And what that does is opens up a line of credit for you to use for whatever you want. It doesn't have to be for real estate. I could technically cash my HELOC out and go to Vegas and put it all on black if I want it. They don't regulate that, but whatever I pull out of it, I do have to pay interest on that amount. So let's say you got a $300,000 line of credit, a home equity line of credit. The house is being used as collateral. It's a second position mortgage on your home. But if you never use the money, you got a $300,000 line, but you never use any money, you don't have to pay any interest on that money. You got to pay maybe some annual fees or something like that to keep the account open, but you never have to pay interest until you use it. So what we did is we both got these lines of credit, and then as deals came up, now we had our cash and we had our lines of credit to use, which allowed us to scale into doing more deals at a time. So let's say again, another $150,000 deal comes up. I've already got my cash tied up in a deal or two elsewhere, and I want to buy this good deal. Now I can tap into that. I can pull out 100 grand to buy it, 50 grand to fix it up, and then just pay interest on that money as I'm using it, right? So that does come at a cost. I've got to pay the interest on the money, but I know that cost going into it. I've already, even if I was using my cash, I'm already computing the cost of that cash, right? Well, it's really no different than computing the actual interest cost of a HELOC. So I calculate that, and now I either go through the process and sell it and then pay my HELOC back down to zero, or I burr it, which is the refinance piece, and I'm going to hold it into my portfolio, but I refinance it. Again, through that refinance, I'm paying my capital back to myself, and then I pay it back to the HELOC, getting that balance back to zero. So we use that quite a bit, and the next step for us was an unsecured line of credit. So we got to a point where we were doing more deals than we could fund with our cash, and then we kind of tapped out on our HELOCs. And then our next step is we went to our bank, a local bank, and negotiated an unsecured line of credit. Unsecured meaning there is no collateral. They're not, only thing they're approving us based on is our bankability, meaning our tax returns, our credit, and their faith in us to be able to manage that and pay the interest as we use it and pay the money back, as we can. So both of us at the same time went to the same banks. We were very bankable. We had good income jobs. We had a good portfolio building. We had a good track record with that bank, and they gave us pretty sizable unsecured lines of credit. Now, the cost of that capital is a little bit higher than a HELOC, right? HELOC is going to, it's got collateral. It's a little bit lower risk loan for the bank, whereas unsecured has no collateral. They're just putting faith in us only. So we pay a little bit, maybe a point more interest, 1.5 more, but that gives us now another fresh source of capital to buy these deals, right? So fast forward, we eventually tapped out of that, right? So tapping out meaning now we have all of our HELOC money in deals, we have all of our cash, and by now we're holding more of our cash. We're trying to remain more liquid, so because we have these lines of credit, we were using that rather than cash. But eventually that gets tapped out. Next step we went to was private money, right? So we went to We had one individual that agreed to essentially give us a line of credit that we would use to take down deals. And we just, the deals we were buying, he would be the lien holder on those deals and in first position. So if we defaulted or did anything bad, he could take over the property and finish it out and do whatever he wants with it. But we gave him a lien on the property. We would pay interest to him as we used the money, and that allowed us to get into more deals, right? So that, I think at one point we had about, I don't know, maybe $500,000 of private money from one individual that we were using. And that closed and allowed us to, with our HELOCs and our lines of credit and our cash, and that's where things really scaled up for us. So far we've covered cash, self-directed retirement accounts, home equity line of credit, unsecured line of credit. So you go to a bank, you have to be bankable to do that, but that's an option. And then you got private money. So private money is just what it is. It's a private individual that has cash in the bank, or they might have a retirement account that they want to lend out of or make loans out of. You just go to them and you negotiate whatever terms that they'll be willing to give you. Usually they're going to be favorable terms. It's going to be somebody that already trusts you and knows you. A lot of times, maybe not, but they're going to, before they give you any money, they got to have some kind of trust or faith that you're going to perform. And you build these relationships. Private money, it's easy. It's not easy to find private money, but once you have it set up, it's basically a phone call. I've got this deal. Are you interested in it? Sure. Here's 200 grand. I'll pay you 12%, 10%, whatever you work out. And you take down the deal. There's your source of capital. Then beyond all of that I've covered so far, this is where you get into kind of the world that we operate in at 608B Capital. And this is going to be more of your what we call hard money, right? So at 608B Capital and a lot of other lenders that we collaborate with, there's kind of a mixed definition of what a hard money lender is, right? When we first started out, I hated the term hard money. And the reason I hated it is because it had such a bad connotation in the investor space, right? People hear hard money, they think super expensive, super difficult, and it just had a bad connotation, a bad reputation. Well, at the end of the day, a hard money loan is a loan that's secured by a hard asset, right? That's the way I look at it. But at the same time, we can be hard money lenders, but also operate as a private money, like with private money operations. And what I mean by that is, as a hard money lender, some hard money lenders are backed by institutional money. That means they have these big conglomerates, private equity firms, banks, whatever the case may be, but that's their source of capital. So it's a lot of red tape they have to work through to be able to release that money to go into a deal. When I think hard money, that's typically what I'm thinking of. What we do is we basically have investors and our own capital in a fund, and we have full control of that capital. We don't have any red tape we have to go through or anything like that. If we like a deal and it fits within our criteria, we're going to fund it, and we control all that in-house. So yes, we're a hard money lender, but we operate more consistent with what you see from private money lenders. Yes, there's points. Yes, there's interest and things like that. Yes, on a short-term basis, relative to long-term interest rates, it is an expensive loan, but it's a short loan. So, but that's your next option of funding. And once you reach a point of scale where you're doing multiple deals at a time, or you're someone who's finding good deals, but you just don't have these other options. You don't have the cash. Maybe you don't have the equity in your home to get a HELOC. Maybe you're not bankable enough to get an unsecured line of credit. Maybe you don't have folks in your network that would be willing to write you a check to buy a deal. So you've exhausted all that. You don't have it. Hard money is going to be your best option, working with a company like 608B Capital, or I'll shout out Rehab Wallet down in South Carolina. They're our mentors. But companies like that, that's where they can be a big part of what you're doing. A lot of folks listening to this, that might be where you need to start, right? Again, you don't have the cash, you don't have the relationships, you don't have the HELOC, you don't have the unsecured line of credit, you don't have the retirement account that's self-directed, but you've got deals and you know how to find deals. Well, if that's you, where companies like ours are where you got to start. You go to, you present your deals, you go through underwriting, and they can back you. Yes, it's going to be more expensive than cash. Yes, it's going to be more expensive than HELOC. Yes, there'll be a little more red tape to get through. But at the end of the day, it's not that difficult. And once you establish those relationships, then you can roll with them. We have borrowers that, they're doing 200 deals a year. We might fund, 20 of them, right? So what they've done is they've lined themselves up with all kinds of funding networks and resources through private money or various hard money lenders, and we are just fortunate enough to be one of them, right? So find them, find your hard money lenders. Even if you don't need them now, connect with them, connect with us at 608B Capital, or do some research and find other ones that you might align with and connect with them. So there are, and there's one more, and this would get, I'd have to spend a whole podcast episode kind of explaining this, but I would do it at a high level. There's one more way to take these deals down. So like I said, I've covered cash, I've covered the HELOCs, the retirement accounts, the lines of credits, the private money, hard money. Then there's seller finance, and that's the one that it's kind of become popular recently because interest rates have gotten so high and it's just tough to make numbers work. So people get creative, and seller financing's been around forever, but you're just hearing a lot more about it now. But we bought 8 duplexes a couple years ago on seller finance, and where this can be good is, maybe you don't have the cash, maybe you don't have all the other relationships or access to anything else I've talked about, but you've got somebody with a really good deal, and let's say it's somebody that doesn't necessarily need all the cash at once when they sell it. So they'll agree to take it in payments. So what they'll do is they'll sell you the deal, deed transfers, now you own it, and maybe you put 10% down. So let's say you're buying it for 200 grand. Maybe you put 10% down, so you bring 20 grand to the table, and they're going to hold the rest of it in first, as a first mortgagee, essentially. So instead of a bank being the lender on the loan, or a hard money lender or a private lender, that person you're buying it from is going to stay in that deal as the lender now. So they're going to go from owner to playing the role as a bank, and you pay them monthly payments based on whatever terms y'all lay out. You might do it, you got a balloon payment in 5 years or 2 years or whatever the case may be, or it might just be a year to give you enough time to fix it up, renovate it, and either sell it and pay them off or refinance it and pay them off. But that is a fantastic option, and really, in a lot of cases, should be the option you lead with if the numbers make sense and if it makes sense for that seller. We always, when we have deals come across our plate, 99% of the time, the first question we're going to ask is, are they open to seller financing? If they are, then we're going to talk through that as an option before we talk through cash or any of these other options, because it's just a cleaner way to take a deal down. So those are really, at a high level, your better or your best, and really, I think I've covered most of your options to fund a single family deal. All of these things are available for commercial as well. I'm not going to get into all that, but commercial is just more zeros behind it, right? It's bigger deals, more complexity behind them, and things like that. So now, as I do every episode, there's a mindset that goes into this, right? So I'm going to transition now to our next segment, which is the mindset segment. And we're going to talk about resourcefulness when it comes to all this. But before I do that, I'm going to turn it over to our sponsors for a word from 608B Capital, and we'll be back in just a minute. If you've been following this podcast for any time now, you have certainly heard us talk about 608B Capital. 608B Capital is our lending company that Bill Phillips and I launched about a little over 2 years ago. And we fund folks that are buying houses, fixing them up, and then ultimately selling them or refinancing them for longer term use. And we're the short term financing for that. So if you have anyone in your network or you yourself are into that business or interested in learning more, you can reach out to us by checking out our website, 608bcapital.com. We always have plenty of capital to lend, and we're excited to work with as many new people as possible. We also have an excellent referral program, so contact us for more information on that, and we can't wait to hear from you. All right, 608B Capital, kind of fitting for this episode because obviously we are a lending institution or company as well. So if you are into this kind of stuff, you're looking for sources of capital, start with us. We'll happy to talk to you and go further with that. So, mindset, resourcefulness. Resourcefulness, I think, out of all the things I talk about when it comes to mindset, is probably the one that I have mastered the most in my life. Just being able to figure stuff out. It's kind of it's the thing I'm most proud of, that you put me in any situation, any circumstance, my brain is not going to crumble. It's going to go right into figure it out mode, right? Being resourceful. How can I figure this thing out? We have this rule in my house there's one word, couple words we can't say, but one main one is can't. If I hear my kids say I can't do something, they know what's coming behind it, a lecture, and we're going to figure out how they can do it. They know not to say it. They catch themselves all the time saying it, and my daughter does it so funny. She'll say, "Dad, I can't." She'll correct herself and says, "I'm having trouble figuring out," and then we kind of work through it. But you got to be resourceful. So finding deals, you got to be resourceful doing that. Underwriting the deals, got to be resourceful. But you better be resourceful when it comes to figuring out how to pay for these deals once you have good ones. So I just went through all the ways to do it, to finance deals. They're not all going to be clean. They're not all going to be perfect. So you're going to have to get creative. You're going to have to be good at figuring out how to connect the dots and make this work so that you can fund this and do so responsibly in a way that you can still remain profitable, not lose money, and be able to take care of your obligation to whoever funded that deal. If it's not cash or your own money, then you owe somebody something on that, whether it's interest, a payoff, whatever it is, you owe them money. So you got to be resourceful in knowing how to do all that responsibly. But resourcefulness in real estate, obviously important, in business in general, but it's important to be resourceful in every area of your life, right? I always tie it back to, mindset when it comes to health, right? And fitness. Resourcefulness shows up every day almost in my life when it comes to that, right? There are many days that I get so busy, I don't get my workout in early on, right? I like getting it in first part of the day. Today's a great example of this. I forget when this episode's coming out, but it's 1:00 in the afternoon. I hit the ground running this morning real fast, and I've been doing a lot of stuff today. I've not gotten a workout in. I got a lot more to do, so I'm going to have to get resourceful at some point this afternoon or tonight to squeeze in a workout. I have to get it in because of I work out every day, so I'm going to have to get resourceful. That might be later today while, like, my son has baseball practice. I've got to run the practice tonight. I'll figure out maybe a way to that hour and a half get myself worked up in a good sweat by being active in that practice. That might be able to be my workout. Or maybe I go out for a jog this evening when I get home late at night, put the kids to bed, and I'll take the dogs out, and for 45 minutes, an hour, just go do a real fast-paced walk or a jog or something to work up a good heart rate and a good sweat. But a lot of times you got to get resourceful. If you're not resourceful, you just say, "Oh, it's gotten to the end of the day. I can't figure out a workout. I'll do it tomorrow." Same with diet. I'm on the road a lot, traveling around, doing my thing. And I'll give you a great example. the other day I was in Williamsburg, and I had a meeting over there. Yeah, I was over there for something, but that doesn't matter. And I had not mapped out what I was going to eat that day, right? So I left the house early in the morning. I typically don't eat breakfast throughout the week, so my first meal will be at lunch. And usually when I go, if I'm in a city like Williamsburg, um, I'm going to find the Chick-fil-A and go get something unhealthy and just scarf it down. I was like, no, I'm not going to do that. I'm over here. I didn't map out lunch. Now I got to get resourceful to make sure I stay healthy. And so I was, after my meeting, I was sitting in my truck. I was like, all right, I Googled Williamsburg healthy restaurants. And the restaurant, it's kind of like it's Cava, C-A-V-A. I've only eaten there once in my life, and it was good. It was just a couple weeks ago, but I was like, all right, I'll go back there. They had some healthy options. So I go in there, and I get some kind of bowl that they had. It had lettuce in it, and rice, and beans, and some steak, and avocado, and feta cheese. It was a really healthy, but tasted phenomenal. So rather than going to my go-to, which was easy, going to Chick-fil-A and getting a chicken sandwich and fries, I chose to be resourceful and find a healthier option that wasn't going to take up too much time, and I was able to accomplish my goal for that meal, right? Resourcefulness also, we live it every day with kids, my wife and I. They're all over the place. Like every day, both of them most days have some kind of practice or activity that they're involved with. And every day we're just figuring it out. Now, most of the time leading into the week, we've mapped out everything. So we kind of know, all right, you got JJ for this day, you're taking him here. I got Emma, and you take JJ or Emma this day, blah, blah, blah. We've got all that mapped out. But a lot of times things just come up and kind of throw our schedules off. So we've got to get resourceful. That's fine. We don't panic when things get thrown off. We become resourceful. We figure it out. And my family, we joke all the time. We're not allowed to say can't. I talked about that. But our motto, probably shouldn't say this in front of the kids, but we do, and we don't care. They know they're not allowed to say it quite like this yet. But what we do in our house and our family is we figure shit out. I'll say it again. We figure shit out. Nothing's too big that we can't figure it out. So I'm instilling that into my kids because they see my wife the same way, that we do not panic when things get rough. We ask ourselves this question. I ask my kids all the time. Is this a small problem or a big problem? 99.9% of problems are small problems. If they're small problems, we can figure it out. We figure shit out. So that's the mindset I take into every day I go forward with in life. I try to instill in my kids. I try to empower the people on my team and people around me to be the same way. I try to lead by example, and then I apply that to my business, real estate, everything else. This podcast, everything I'm doing, I try to lead with that resourcefulness mindset, and I get better results because of it. It's not always perfect. It's not always pretty. It's always chaotic because that's just the world I live in, but I figure shit out. And if that offends anybody, I apologize, but that's just my mindset going through every day. So with that, we'll start wrapping things up. Again, I appreciate you guys following along and supporting this. I hope this is for the folks out there that know these things back and forth. You're probably not getting much out of it, but maybe you are for the mindset nugget. But I encourage you, if you're listening to this, share it with folks. Share it with folks that might get something out of it. They might be interested in real estate. They might be interested in these little mindset nuggets. Keep sharing it, because that's all I do this for, is to try to inspire folks and encourage them to think differently, try new things, be resourceful, and figure it out. So with that, we'll wrap up another episode of Burning the Ships solo, and I will talk to you guys next week. Have a good one. Thank you for joining us on another episode of Burning the Ships podcast. As always, want to thank our sponsor, 608B Capital. We are a short-term lending fund, a debt fund, open for investors who are looking for a passive return, and also we offer products our main product to fix and flippers and buy and holders, folks that are doing things like that in real estate. Also want to remind you about our referral program. Check out our website for more information on that, and we're happy to talk to you further if you're interested. Again, thank you for joining us on Burning the Ships, and do me a favor and go out and try to find someone or some way that you can add value into the world today. Think through it, zoom out, and try to find where you can add value. I think it'll help wrap up your day, wrap up your week, whatever you're working on a positive note if you constantly think that way. Where can I add value? So with that, we thank you for joining us on another episode of Burning the Ships. Have a good one.